All right, so we're going to kind of pick up where we just left off with the sales discounts. We're going to kind of jump into an example here. All right, so let's kind of walk through. So Comfort offers customers who purchase on account a 2% discount if they pay their invoices within 10 days. Amounts not paid within 10 days are due in 30. So the terms of that would be 210 net 30, like we just described. So the following events occurred. So in scenario one, on April 5th, 2022, 49er Company sold merchandise at a price of $40,000. And then the customer paid $39,200, which is, a 2% discount on April 14th, 2022. So you can see they're within the 10 days. And so they're able to take the discount. And so that's why they only paid $39,200. They'd been outside the 10 days. They've had to pay the full $40,000. And so it's kind of walk through the two different methods. So we have the gross method on the left and the net method on the right. And so let's record the initial sale of $40,000. So with the gross method, you record the sale for the full amount, $40,000. Whereas with the net method, notice you record it assuming that the discount is going to be taken. And so that 2% discount, so $39,200 is a 2% discount off the $40,000. So we're at 98%. And so anyway, so that's what they would record initially using that net method. So gross versus net. Now, in the second piece, which is when the payment takes place, sort of, again, two scenarios here. So with the gross method, obviously, since the payment was made, if I can find my cursor, they did not have to pay the full amount. So they paid, 98%, a 2% discount. But my receivable is still a $40,000 receivable. So notice, the balance here. Oops, brought it a little too far over. That's okay. It doesn't change the receivable amount. So obviously there's the need for an additional debit. And that's where that sales discount account comes into play. And so that sales discount is obviously going to make up for the difference. It's that 2% discount amount. Notice the type of account. It is a 400 series. So it is a contra revenue account. And so it's in the 400 series and it's recorded in that part of our accounting system, but it has a debit balance. So it is a contra revenue account. And we're going to talk about how it's presented and everything like that. But just understand it is a contra revenue account. So when you have a journal entry on the test, make sure you note the numbering system. It's in the 400s. Now on the net method, it's pretty straightforward. Nothing going on there. With our net method, we just collect for the amount of our receivable. No other accounts are needed. So when we report this information on the income statement, there's the sales revenue, and then we're going to talk about the two accounts that could be part of this type of transaction. The one that we're introducing first is the discount. And then on the next example, we're going to go through the discount forfeited. But we're going to show you how you report each. And so with the gross method, of course, we report the 40,000. But with the net method, we only had the 39,200. But of course, with the gross method, we have that discount. Notice that it's reported as a negative because it is a contra revenue account. Of course, there is no sales discount with the net method, and both of them would then report net sales revenue of 39,200. But notice at the very top line, with the gross method is initially higher. We just have this adjustment because the discount was taken. So again, that's comparing the net versus the gross method. All right, so let's take scenario two. So with scenario two, again, same sales price. Nothing really changes there. So same entries, whether in scenario two, we're going to talk about where they don't take the discount. So in scenario two, situation now where we have the receivable, we have the sales revenue, and then we have the gross amount on the left and the net amount on the right. But in this case, let's say that they didn't pay until May 4th. And so they did not qualify for the discount. So they have to pay the full 40,000. On the left-hand side, pretty straightforward, like we've always done. I collect the $40,000 cash, we're good to go. On the right-hand side, it's a little bit different. Of course, because we know the carrying amount of the receivable is $39,200. but the cash received is 40,000. And so we have this difference between the two. And that difference is called a sales discount forfeited. And it is a normal revenue account. It has a credit balance. But notice that it is in the 400 series. The discount was also in the 400 series, but it was a contra revenue account. It had a debit balance. And so in this case, we have an $800 credit balance to our sales discount forfeited account. And so again, how would we then present these? Gross method on the left, net method on the right. Gross method, net method, we still report the same sales revenue on top. There's no discount in either case, but notice with the net method, now we have this additional account, this $800 sales discount forfeited account, which then increases the net sales revenue to 40,000. And so in both cases, whether you took the discount or not, our net sales revenue is just going to reflect whatever we received. But you can see with the gross method, you start with the sales revenue and then you may subtract a discount. With the net method, you start with the sales revenue and then you may add a sales discount forfeited. And so you can kind of see the difference between those two. And you can review that obviously several times to kind of get the difference between the two, both in terms of the journal entries and what you would report on the income statement. All right, so let's kind of think a little bit more about this net method. So when we think about this, when you think about the sales discount forfeited, it's you believe that this makes sense. In other words, just in theory, when we think about what that discount forfeited account is capturing, essentially, what is it capturing? And I want you to think about it for a second, maybe pause the video, but essentially, if I'm thinking about that net method, we said, okay, you owe us 39,200. Okay, you didn't pay us, so now you owe us 40,000. Right? That's kind of one way to think about it. So what's the implication of that? Just kind of think through it on your own. Obviously, in class, we'll talk about it a little more. But does it really represent the economics? In other words, it's treating it as another portion of the sale. But really, it's not. If you think about it in substance, that $800 forfeited discount is a form of interest, right? Because anytime that you delay payment, you get charged interest, right? And essentially that's what it is. And so essentially what ForDiner did is they financed the sale for $800. So in other words, instead of getting paid within 10 days, since we allowed them to pay within 30, we charged them $800 to do that. And so I think theoretically, it's more like interest revenue rather than an additional form of sales revenue. But under ASC 606, which is the new revenue recognition standard, it deems the difference when it comes to this sales discount term, it deems it as immaterial. And so it does not view the $800 as a material part of the transaction, and therefore it allows them to include it in their net sales revenue. And so instead of being presented, as interest revenue further down the income statement. So I'm not sure that's theoretically sound, but it certainly is pragmatic, I guess. And so again, hopefully in class, we'll have a nice discussion over that. Obviously, in this kind of format, not a whole lot of discussion. All right, so let's see. I think I'm going to pause there, and then we will pick up the next section with the next lecture.